three and a half hours to go through it. So we will kick off momentarily. My suggestion is that around 12 noon or so, we can take a 10-minute break and then regather. So let's plan on doing that. Ernestine, please begin with a roll call and the notice of the meeting.
Certainly. Notice of the regular meeting scheduled for 2024 calendar year was posted on the division's public website and mailed to the Star Ledger, the Bergen Record, the Courier Post, the Trenton Times, and emailed to the Secretary of State on December 12, 2023. A copy of the notice was posted on division's website and is on file. Roll call, Mr. Aronson.
Present.
Mr. Bore. Mr. Bruno.
Present.
Mr. Carr.
Here.
Mr. Cleary.
Here.
Mr. Crow, have you joined? Are you with us?
You and present.
Excellent. Mr. Greeny.
Here.
Mr. Hanson.
Here.
Mr. Liebtag.
Here.
Mr. McGuckin.
Here.
Mr. Pandiri.
Here.
Chairman Raj.
Here.
Mr. Richard.
Here.
Mr. St. John.
Here.
And Mr. Yarensinski.
Here.
We have a quorum.
Great. Thank you very much, Ernestine, and welcome again, everybody. So the first agenda item is a motion to approve the public session minutes. I did notice one correction there that I would like to make, and please make that correction if you can. In the nominating committee, we should have Mr. Cleary, not Mr. Greeny, as a member of the nominating committee. So assuming that that correction is made, do I hear a motion to approve the minutes, please?
You keep dropping in and out.
I didn't have a chance to test my mic, but.
So
Liebtag moves the meeting minutes.
second.
Thank you, Mr. Liebtag. Thank you, Mr. Aronson. Any discussion on the meeting besides the point that I made already? Okay, hearing no discussion, please take a vote by roll call.
Sure. Vote by roll call to approve the minutes.
Approved.
Mr. Aronson. Mr. Bore, are you with us yet? Mr. Bruno.
Approve.
Mr. Carr.
Approve.
Mr. Cleary.
Approve.
Mr. Crow.
Approved.
Mr. Greeny.
Approved.
Mr. Hanson.
Approve.
Mr. Liebtag.
Approve the minutes as revised.
Mr. McGuckin.
Approved.
Mr. Pandiri.
Approved.
Chairman Raj.
Approved as revised.
Mr. Richard.
Yes.
Mr. St. John.
Aye.
And Mr. Yarensinski.
Approved.
So moved.
Great. Thank you very much, Ernestine. The second item here is approval of the minutes of the regular meeting, but the executive session. Would one of the council members please take a motion to approve and to second?
Motion by Cleary. Second by Liebtag.
Thank you, Mr. Cleary. Thank you, Mr. Liebtag. Ernestine, and any discussion on the minutes there? Okay, Ernestine, please take a roll call vote for the minute approval also.
Sure. Mr. Aronson.
Approved.
Mr. Bure. Mr. Bruno.
Approve.
Mr. Carr.
Approve.
Mr. Cleary.
Approve.
Mr. Crow.
Approved.
Mr. Greeny.
Approved.
Mr. Hanson.
Abstain.
Abstain. Mr. Liebtag.
Approve.
Mr. McGuckin.
Approve.
Mr. Pandiri.
Approved.
Chairman Raj.
Approved.
Mr. Richard.
Yes.
Mr. St. John.
Aye.
And Mr. Yarensinski.
Approved.
Excellent.
Great, thank you very much. The motion carries. We are moving now to agenda item number 2. I would like to invite Assistant Treasurer Michael Kenneth to provide us with a report. Good morning, Mr. Kenneth. Welcome.
Good morning, and thank you, Chair and various members. Short report this month. Earlier this month, Division of Taxation began issuing anchor payments to eligible taxpayers, and as of this week, almost 1.5 million rebates have been released, totaling almost $1.7 billion. Payments will be distributed on a rolling basis until all eligible applicants receive their benefit. Applications continue to grow each year. This year, Division of Taxation received about 225,000 new applications. Second item, Moody's Investor Service has upgraded New Jersey's outlook from stable to positive, noting that the actions incorporate solid economic and revenue performance that supports the state's efforts to maintain strong fund balances and continuing to fund the full actuarial pension contribution. Agency also cited budget surplus significantly larger than the state's historically maintained. And finally, revenue. September revenue collections from major taxes totaled approximately $4.9 billion, up about 1.7% over last September. Year-to-date collections of about $8.2 billion are higher by about 4.3% for the same period in the last fiscal year. And these projections closely follow the fiscal year 25 projected growth. So we are, from a revenue perspective, in line with expectations. And that's the full report for this month. Happy to take any questions.
Any questions? Thank you for that update, the positive update, Michael. We appreciate it.
Thank you.
We are now on agenda item number 3 to establish a schedule of dates for next year's SIC meetings. The dates were included in the package that we all have. Do all of you have the dates? Well, you can see them here also. Thank you, Ernestine and Gary. Any comments on the dates provided? Okay, great. So we are going to be adopting those dates here. The fourth agenda item we have is the election of the State Investment Council Chair and Vice Chair. So under the bylaws, an election is to be held at the first regular meeting after the nominating committee is elected. At the July meeting, Ted Aronson, Michael Cleary, and Tim McGuckin were elected to the nominating committee. It is the responsibility of the nominating committee to confer and agree upon nominations for the chair and vice chair to be recommended to the full council. At this time, I will ask the nominating committee, represented by Mr. McGuckin, to make their recommendations to the full council, please. Over to you, Tim.
Thank you. Our nominating committee met to discuss the role of chair and vice chair. As part of our process, we solicit feedback from the rest of the council regarding the positions. We all understand the time commitment and the dedication necessary to perform these roles effectively. The committee truly appreciates the work that Mr. Raj and Mr. Leaptag put into these positions, and that sentiment was also evident in the feedback that we received from the rest of the council. So as a result, the nominating committee would like to recommend the nominations of Deepak Raj as chair and Adam Leaptag as vice chair. And if you need me to do them individually, that's fine. Just let me know how you'd like that to happen.
I think that is fine. Thank you very much for all the time that you have taken and the committee has taken. And thank you for your recommendation and your support. Let me do this. Let me turn it over to Vice Chair Leaptag to go through the nominations for the council chair. Mr. Leaptag, can you take over and go through this nominations process? Thank you.
Yes, I can. Thank you. So thank you to the committee for the open and inclusive process and for the nomination. I appreciate it, and I know that Chairman Raj appreciates it as well. I will take over for purposes of nomination for the chair. There's a nomination for Deepak Raj for chair of the SIC for 2025 on the table. Ernestine, could you please conduct a roll call vote?
Sure, do we need a motion and second, Pam?
Tom Bruno, I'll move.
Thank you. Sorry.
Excellent. Roll call. Mr. Aronson.
Enthusiastic, yes.
Mr. Bure, have you joined? Mr. Bruno?
Absolutely, yes.
Mr. Carr?
I'm also a yes.
Mr. Cleary?
Yes.
Mr. Crow? Mr. Greenie?
Yes.
Mr. Hanson?
Yes.
Mr. Leaptag?
Yes.
Mr. McGuckin?
Yes.
Mr. Pandiri?
Yes.
Mr. Raj?
I will abstain. I will pass. Yes.
Mr. Richard?
Yes.
Mr. St. John?
Aye.
And Mr. Yarensinski?
Yes.
Motion carries.
Thank you.
Thank you.
And so with thanks for your service, Mr. Raj, I'm happy to pass the microphone back over to you.
Thank you very much, Vice Chair Leaptag. I appreciate that, and thanks to the committee, for their support. Let me at this time invite nominations for Council Vice Chair. As you know, we have Mr. Leaptag's nomination on the table. If there's anybody else who's interested, please raise your hand. With no further nominations, may I have a motion to elect Vice Chair Leaptag to serve as the Council Vice Chair? Do I have a motion, please?
Motion.
Second.
Thank you very much. Ernestine, please take a vote by roll call on the motion to elect Vice Chair Leaptag as a Council Vice Chair.
Sure. Mr. Aronson?
Absolutely.
Mr. Bure? Mr. Bruno?
Absolutely, yes.
Mr. Carr?
Yes.
Mr. Cleary?
Yes.
Mr. Crow?
Yes.
Mr. Greenie?
Yes.
Mr. Hanson?
Yes.
Mr. Leaptag?
I'll vote yes this time.
Okay. Mr. McGuckin?
Yes.
Mr. Pandiri?
Yes.
Mr. Raj?
Yes.
Mr. Richard?
Yes.
Mr. St. John?
Yes.
Mr. Yarensinski?
Yes.
Motion carries.
Thank you, everyone.
Thank you very much. Thank you, Ernestine, and thank you, Mr. Leaptag, for your service. I just want to publicly acknowledge what a terrific partner Vice Chair Leaptag has been for all these years, and I look forward to this partnership as you go into 2025. So thank you.
Thank you, you as well.
Let's move on now to the appointment of members to the Audit, Executive, ESG, Governance, Operations, and Investment Policy Committee. The appointments here, there's really no change in the members, and we have the list here up on the screen. So if you all can just visit that. If there's any comments, we can do that now. Otherwise, we can move ahead. Great. Thank you. So thank you very much to all of the members here for their service, and we look forward to working together in 2025 as well. We appreciate it. Let's move on to the director's report now and update. Over to you, Director Khan, for your report.
Thank you, Chair. Good morning, Chair, Vice Chair, Council members, and good morning to everybody that's attending and participating in today's meeting. Very nice to see you all. As you know, each year during the October State Investment Council meeting, we provide the performance results for the last fiscal year. Consistent with that, today we will also be providing fiscal year 2024 performance results. Please keep in mind that the financial audit is still underway, which is typically the case each year. And so as we discuss the performance results today, just keep in mind that these are unaudited results at this time. Let me start my presentation, Gary, if we can, on page 2. Thank you so much. This slide provides a snapshot of the capital markets as of June 30th. So of course, we are discussing year-end, fiscal year-end, June 30th, 2024 here. I won't spend, given that, time lapse that's taken place, I won't spend too much time on this slide other than to say, something that we all have seen and continue to see is that markets have remained constructive throughout the year, despite a number of lingering concerns. And of course, those include conflicts and around the world and inflation from an economic perspective. But nonetheless, markets continue to remain constructive. Equity markets clearly stood out and continue to stand out in terms of performance. And so this I'll leave it there, but let me pick up on in terms of just where our asset allocation and performance was as of June 30th. If we can go to slide 3, Gary, and I'll pick up on performance first. Let me address that if I can. As you will see, the pension fund portfolio's fiscal year 2024 return is 10.74%. That's outperforming the portfolio's 7% long-term assumed rate of return by 374 basis points. I would also point out that throughout the year, the portfolio was meaningfully overweight towards cash and cash equivalents, and therefore allocating less capital to risk assets. As a result, the portfolio's risk profile was much more cautiously positioned. So if you think in terms of risk assets versus risk-free assets, throughout the year, the portfolio on average had an allocation of 92% to risk assets and 8% to risk-free assets, given the cash holdings. Nonetheless, that did not prevent us from generating a double-digit return. Needless to say, we're quite pleased with the fiscal year 2024 results. That being said, the portfolio return is slightly under the policy benchmark, albeit by only 7 basis points. However, given some underweight posturing as compared to the target allocation to a number of asset classes, that is not a surprise. So where in the portfolio do we generate returns? Well, in a few minutes, we will hear from our team members, our investment team members. They'll provide us with more information asset class by asset class. But as a quick summary, you'll see that the U.S. equity book, public equities continued to deliver stellar returns. And we were able to generate 23% for fiscal year 2024 from the U.S. Domestic equity portfolio, with non-U.S. developed market equity markets delivering over 9% and emerging market equity also delivering and generating close to 11%. Additionally, both risk mitigation strategies and private credit delivered over 10% for the year, while high yield on the fixed income side also came in relatively close to the 10% mark as well. By the way, I will also point out on this page cash equivalents, which is a line item in the defense category towards the bottom of the table. As you can see, this provided a return of 5.75% for the year. As you know, we were overweight cash as compared to target. However, with the return on cash just shy of 1.25% or 125 basis points from the long-term assumed rate of return, it's a very good risk profile for the portfolio to have. As a reminder, cash is managed through the internally managed cash management fund, which during the fiscal year, I should say, was managing approximately $40 billion. The cash management fund is designed as a short-term investment fund for the pension fund, as well as the state and several other entities in the state. The bulk of the capital within the cash management fund is actually invested in U.S. government securities. So my point to going towards the risk-free assets. Now, please allow me to touch on the asset allocation columns on the left of the table. So while we were overweight cash, and I've touched on that, and underweight some of the asset classes, we remained fully invested in some of the other asset classes. Throughout the year, we did not see any clear signs to be too far away from the target allocation for U.S. domestic equity. And so therefore, we remained relatively close to target, at times over and at times under. And this has worked well as the domestic market continued, certainly the domestic equity market continued to roar ahead on the back of strong economic growth, consumer confidence, and positive investor sentiment. As of June 30th, the portfolio positioning was slightly overweight U.S. equity. We also remained relatively close to other equity markets, with the exception of emerging markets. Within private markets, we remained underweight in each of the 5 asset classes. which make up that portfolio. This has allowed the portfolio to avoid any liquidity issues. And as you know, we have completely avoided the denominator effect, and therefore we're not a forced seller at any point during the year. In fact, the ample liquidity we have today and have continued to hold throughout the year allows the portfolio to have dry powder and a buyer at a much more reasonable valuations. I'd like to move on to presenting an update for September 30th. However, let me pause here for any questions related to what I've talked about so far, and specifically through June 30th and the fiscal year 2024.
Any questions from the committee members? Yeah, please go ahead.
Thank you. I'll continue, Chair. Gary, if we can go to slide 4, I'll run through these relatively quickly because I think most of us are aware of where the markets are. These are, again, the capital market returns through September 30th, 2024. As you know, markets continue to remain positive. In fact, these days, we're actually seeing some record highs in the equity markets, and we'll continue to watch that, of course. Slide 5, Gary, if you would, be kind enough. Here we have the performance similar to what we just talked about as of June 30th. We have it as of September 30th, 2024. You can see preliminary fiscal year-to-date performance of 4.22%. However, we do not have updated return numbers for most private asset classes, which is typical. There's a quarter lag, or at least a quarter lag, as you know. So please keep that in mind. On the left, you can allocations. Sorry, was there a question there? Okay, I'll pause in a few minutes if there are. So please keep that in mind. But you can see the allocations as of September 30th, and you will see that we continue to be slightly overweight U.S. equity. That is also taking into consideration the ramp up and the gains that have also taken place in that allocation. I will pause there for any questions before we move on to notifications.
I would just like to take a moment, Director Khan, to thank you and congratulate you and thank the team for all the hard work that has produced these results. We are well over our bogey rate, and it is really, and I know, and I think you produce these results while managing risk well. And I think that is a very important point very important takeaway, from these numbers. So again, thank you, and thanks to you and your team.
Thank you, Chair. We appreciate it. The team, as you know, works very hard, and we spend day in and day out working on this. So we're absolutely pleased with it and appreciate the support and the encouragement. If there are no further questions, I'll continue with my presentation on slide 6. Thank you so much, Gary. Would like to notify council members about a modification to a previous investment. This involves the portfolio's investment with Brookfield in the real asset space. At the time the investment was committed to Brookfield Global Transition Fund, we also committed $300 million to a sidecar for co-investments. Of that amount, there is still $200 million remaining within this co-investment vehicle, while the investment period for Brookfield Global Transition Fund 1 has ended. As such, the division's team has negotiated an agreement with Brookfield, which would allow the division to allocate, or rather continue to allocate to co-investments, but specifically for co-investments deriving from the Brookfield Global Transition Fund 2. I would say it's excellent work on the team's part for thinking outside the box and trying to continue to make those investments with co-investments that allows, of course, the portfolio to capture investment opportunities and generate gains. But at the same time, as you know, co-investments are usually very different in terms of fees, much lower and often zero fees. And so that allows us to reduce the overall balanced or blended fees, if you will. So I think excellent part on the team's effort there. And of course, we are appreciative and grateful for the cooperation and partnership spirit, which has been demonstrated by Brookfield as well. So I'll pause there for any questions on this particular notification. Okay. I I see no questions. If we can go to the next slide, Gary. Thank you. This slide provides, as we usually do, an update and is a list of investment closings in private market asset classes, and these are the ones that have taken place since the last State Investment Council meeting. As you will see, we have closed on 8 investments since then to the tune of $1.1 billion. These were previously approved, and then, as you know, the process is they go into the investment closings pipeline. Our legal team, the Attorney General's office, and our external legal counsel then go into a negotiation period, and over the next 2-3 months, or however long that takes, with the fund counsel as well as the fund's business team, then get to agreement on the closings. And so these are the ones that have closed. 4 investments in private equity, 2 investments in private credit, 1 in real estate, and 1 investment in risk mitigation strategies. So with that said, unless there are any questions, this brings me to the end of my remarks related to the portfolio update, as well as notifications for now, as well as the investment closings. I'm happy to address any questions that you have on anything that I've covered so far. And then after that, we can proceed over to our general consultants, RVK, and Jordan Cipriani will do the honors there. But let me pause for any questions before we do that. Okay, see no questions. Think of anything, of course, please let us know. In that case, Chair, if you're okay with that, I'd like to turn it over to Jordan Cipriani with RVK to discuss the performance report as of June 30th, 2024.
Perfect. Thank you all. And good morning, everyone. Perfect. Thanks so much for moving forward. Shoaib has already addressed some great capital market context and portfolio review, which certainly informs what you'll see in our report. So with that, I'll just focus on hitting sort of the high-level summary notes in our report through fiscal year end June 30th. Maybe we can just bump to page 12. Every quarter, we provide the council with any notable updates related to the total fund, as well as the investment advisors. That's summarized on this page and the subsequent page. As this group is well aware, the most significant fund update was certainly the reduction by approximately $20 billion in assets of the total fund market value, which reflects the transfer of assets, which was successfully completed to the police and fire retirement system earlier in the year. And then specific to your investment advisors, you'll see a handful of what I would call more informational updates on pages 12 and 13, but nothing critical that would merit any discussion or action at this point. If there was, we would have talked to staff about that already and been bringing it forward to you today. If we bump to page 15, you'll see a quick snapshot of asset allocation. Shoaib really already hit this. Quarter over quarter, picture hasn't changed too much. You all have been running a little bit higher on cash. However, Shoaib noted, staff is addressing the reduction in cash there. And then on the other hand, everything else is fairly close to target. Domestic equities have been a real driver of absolute returns this fiscal year. It's no surprise to see that asset class a little overweight, where I say an asset class like real estate is going to be underweight, a big part of that simply being the denominator effect. If we move to page 16, we show performance ranking versus peers here on a gross of fee basis. Peers as defined as public funds greater than 20 billion in assets. And so for the quarter ending June 30th, you'll see the DOI returned approximately 1.8% on a gross of fee basis, ranking in nearly the top decile of peers at the 11th percentile there. And perhaps more importantly, for the fiscal year ending June 30th, the DOI returned nearly 11%, and that translated to a ranking of about the 14th percentile within the peer cohort. This is, of course, just one data point. All peers will be, in different circumstances, having different goals and objectives, and in turn, varying asset allocations. But nonetheless, from a directional perspective, a fantastic outcome for the DOI for the year. And then if we move forward one page to page 16, I always like to take a look at this because this is a breakdown of asset allocation versus peers. Again, plans will have differing objectives and implementation approaches, but this does help indicate perhaps where there are some similarities and differences, and then allows us to understand what contributed to your strong relative performance versus peers that we showed on the prior page. And so generally speaking, you'll see your U.S. equity allocation ranks about 2/3 of your peers. And U.S. equities really dominated the fiscal year, so that was certainly accretive. Fixed income, while posting very attractive returns for the total fund on an absolute basis this fiscal year, didn't quite keep up with equities as you would expect. And so given that you all have a somewhat lower fixed income allocations versus peers, that actually contributed to your relative ranking on a performance basis. And I will add that if we were to look at just US fixed income versus peers, we're showing total fixed income here, your allocation wouldn't look quite as low versus peers, as subplans have more global fixed income allocations that are bucketed a little bit differently. So there's just always different ways to sort of slice and present this data. And then finally, within real estate, which had a bit more of a challenging year through June 30th, this was one of the lower allocations amongst your peers. So that actually further supported your percentile rank relative to peers on a performance basis. So just a little bit of color there. And then page 19, just want to move ahead a few pages here. RVK calculated the attribution of your net of fee total fund return relative to your policy benchmark. The difference between the total fund and the benchmark for the fiscal year is very marginal, largely flat. Shoaib already nicely summarized much of the drivers of performance in his remarks. And here we just break down the math. And so just a couple summary comments here. Generally speaking, if you look at the top right, you'll see that asset allocation versus policy detracted very modestly. And then that was, of course, partially offset by your positive manager value add and a little bit of residual portfolio movement. And then to add color to that, if you look at the bottom left chart, we kind of break those down. You'll see the total fund was modestly underweight its global growth target, as discussed. As we talked about earlier, equities really drove the portfolio and the benchmark return. So that did contribute to a very small lag from an allocation perspective. Similarly, within the defensive portfolio, that added notable positive absolute and relative performance for the fiscal year. It was overweight its target, largely because of that cash position. So in a fiscal year where equities outperformed on the whole, this overweight contributed to a minor lag, although modestly, took risk off the table for the total fund. And then all of this was offset by some positive value add from the real return allocation. So being underweight the target was helpful from an asset allocation perspective. And then significantly outperforming that composite benchmark also helped from a manager value add perspective. All of that kind of adds up to pretty marginal impacts on the whole. And then finally, if we move forward to page 20, we can just bring some of the attribution to light. Here we show the actual returns of the total portfolio and the thematic portfolios relative to their respective benchmarks. And so you'll see for the fiscal year, global growth, your largest portfolio allocation was the real return engine for the fiscal year, returning 15.1%, with the domestic equity portfolio really leading the way within that composite. And then on the other hand, real return, while it did have sort of the lowest absolute contribution in return at 0.8% for the fiscal year, it actually had the highest relative outperformance amongst the four thematic portfolios, which helped keep the total return versus the policy benchmark closer to flat. And that was really supported by some strong performance from the REIT allocation intra real return composite, as well as the real assets allocation. And so with that, I'll take a pause, see if there's any questions before letting some of the asset class experts jump in with more color and detail.
Thank you, Jordan. Any questions from the council members? That was a very good summary. Thank you.
Thank you, Jordan. Thank you, Chair. We'd like now, if you're okay, Chair, to move on to the next item, which is where we're going to have each of the asset class or team members present some information. We'll try to run through it quickly. Obviously, there's a lot we can probably spend an hour on each asset class, of course. That's not what we plan to do, but to give you a little bit of sense of where performance was for fiscal year 2024. So with that said, if you're okay, Chair, I'd like to turn it over. We'll kick off with global equities for us and to turn it over to Lisa Walker.
Great. Welcome, Lisa. Good morning.
Good morning. Good morning, Chair Raj, Vice Chair Leibtag, council members, the DOI staff, Mr. Caniff from the Treasurer's Office, and representatives from HISA, RVK, Axia, Hamilton Lane, Franklin Templeton, and Makita. The division is now going to dive deeper into the pension fund's performance for fiscal year 2024. We'll start with a strong performance delivered across the public equity asset classes, particularly the stellar performance in U.S. public equities. Then we'll move to discuss the fixed income performance, where the high yield portfolios delivered attractive absolute returns in the fiscal year. And finally, we'll wrap up with the private markets performance, where private credit and risk mitigation delivered strong absolute returns. Real estate, delivering slightly negative absolute returns, significantly outperformed the benchmark, partly due to the public global REIT portfolio that delivered a positive return of 5.6% in fiscal year 2024. So starting with global public equity portfolios, the U.S. equities portfolio delivered another exceptionally strong performance in fiscal year 2024 of 23%. This followed the 19% performance delivered by U.S. equities in fiscal year 2023. Melanie Lomez will provide more detail on this very strong performance in her comments. International equities were more mixed. The non-U.S. developed equity markets delivered strong returns both on an absolute basis and relative to our underlying benchmark. International small cap equities and emerging market equities both delivered strong absolute returns, but underperformed their respective benchmarks. As Todd Rowell will provide more details on these two portfolios. As you saw in September quarter end report, we remain overweight our target allocation to U.S. public equities, which continues to deliver the best performance of any asset class in the fiscal year to date, and underweight the target allocation in international equities. I'll pause there for questions. Hearing none, I'll pass the floor to Melanie Lomez to discuss the exceptional performance in the U.S. equity portfolio. Melanie.
Thank you, Lisa. And hello, everyone. This slide shows the returns of the total U.S. equity portfolio for different time periods. Please note the returns are rounded. The total U.S. equity portfolio is now comprised primarily of a passively managed portfolio and a position in a broad market U.S. ETF, which was established in June 2024 as a means to efficiently implement tactical changes in asset allocation. Small legacy positions stemming from the time prior to the move to passive in 2019 have essentially been eliminated over the fiscal year. The portfolio for fiscal year 2024 returned 23.29% versus 23.31% for the USA IMI benchmark, for an excess return of -2 basis points. The primary U.S. equity portfolio is internally managed using a quantitative model to achieve the goal of close alignment to the risk and return profile of the MSCI USA IMI benchmark. This portfolio returned within -1 basis point of the benchmark return for the fiscal year. The remaining -1 basis point, reflects the slight negative impact from a legacy position and the ETF. Next slide, please. This slide provides some statistics of the MSCI USA IMI benchmark to which the portfolio is managed against and the top 10 holdings of the portfolio as of June 30th, 2024. Next slide, please. Similar to fiscal year 2023, the market again was dominated by a narrow concentration of stocks, fueled this time by optimism for the outlook of artificial intelligence and uncertainty regarding inflation and the actions of the Federal Reserve. Yet in fiscal year 2024, the narrow concentration defined by the Magnificent Seven became the Magnificent Five, as concerns regarding the outlook for Apple and Tesla negatively affected their returns. Next slide, please. This slide shows the returns of the total non-US developed market portfolio for different time periods. Please note the returns are rounded. In fiscal year 24, the total non-US developed market equity portfolio, which included the primary passively managed portfolio and a small ETF portfolio, returned 11.67% versus 11.27% for the custom EAFE plus Canada benchmark. Similar to the US portfolio, the primary non-US developed equity portfolio is also managed internally using a quantitative model to achieve the goal of alignment to the risk and return profile of the custom EAFE plus Canada benchmark. The dividend withholding tax policy of the portfolio is a benefit to this goal. Next slide, please. The developed ex-US market equity had a less stellar performance for the fiscal year versus US equity, hurt in part by its exposure to China's economic uncertainty. The top performing countries, Denmark and the Netherlands, reflected the strong demand for weight-reducing drugs and semiconductor technology, respectively. Japan's strong run reflected investors taking note of this market that benefited from inflation and a weak currency stemming from a loose monetary policy. Next slide, please. The next slide provides some statistics of the custom MSCI EAFE plus Canada benchmark to which the portfolio is managed against and the top 10 holdings of the portfolio. This concludes my remarks. If there are no questions, I will now hand the presentation to my colleague, Todd Roholt, to review the EM and international small cap portfolio.
Thank you, Melanie.
Thank you, Melanie. Good morning, Chairman Raj and council members. Gary, if you can go to slide 9, please. Slide 9 shows the fiscal year and historic performance for the international small cap portfolio, as well as the quarterly returns for the fiscal year. While relatively strong absolute fiscal year performance of 8.3%, it was nearly 3% below the benchmark index of 11.25%. Generally speaking, international small cap equities were the worst performing equity class during the fiscal year, and within international small cap growth markedly underperformed small cap value by over 5%. Within the portfolio, the underperformance was driven by allocations to growth strategies as well as a broad market ETF. Consequently, the underperformance this past fiscal year has negatively impacted the longer period numbers where we see underperformance for the 3 and 5 year periods. Gary, next slide, please. Slide 10 illustrates the sector and country weights for the ACWI ex-US small cap index. And the major takeaway here is really the effects of currencies. As you can see, Japan, the largest weight in the index, has stellar local returns, but the weakness in the yen actually resulted in Japan being a detractor to the index in USD returns. The same is true to a lesser degree in the United Kingdom as well as Canada. Gary, slide 11, please. So slide 11, we have the emerging market portfolio. Again, we see the fiscal, historic, and quarterly returns. As you can see, the EM portfolio had strong absolute returns of 10.6%, yet underperformed the benchmark index by 1.8%. Looking at the longer duration periods, the EM portfolio continues to outperform the benchmark index over the 3, 5, and 7 year terms. The emerging market portfolio in general struggled relative to the non-US developed markets as well as the domestic equities for the fiscal year. And this was predominantly attributed to weak performance in China and Brazil. Looking at slide 12, It illustrates the major allocation change implemented during the fiscal year, where the passive and ETF allocations were eliminated and our cash position was increased in an effort to reduce overall risk in the pension fund. While China and India make up nearly 45% of the EM index, DOI, cautious on the outlook of Chinese equities, as well as extremely stretched valuations in India, reduced the overall EM allocation by roughly 2.5%, leaving the remaining allocation entirely with our actively advised portfolios. Finally, on slide 13 is the sector and country weights of the EM index. To highlight here, you can see that China, India, and Taiwan comprise the majority of the index, nearly 65%. Broadly speaking, positive returns were primarily driven by India and Taiwan, and more specifically, standing out was Taiwanese IT, with Taiwan Semi up 75% and carrying nearly 52% of that country index. Although only down 1.5% for the fiscal year, China's weight in the index made it the largest negative detractor, followed by Brazil, which was down over 7% for the fiscal year. At this point, I'm happy to answer any questions, and if there are none, I can turn it over to Kevin and Phil to discuss fixed income.
Thanks, Todd. Hello, everyone. Good morning. So the fixed income portfolio, these are public markets, 10.5 billion of assets, the majority of which is managed in-house by a team of state workers. The exception being about 1.5 billion of high yield, which is managed by a roster of outside advisors. So over the year, we were slightly underallocated overall versus policy. Most of that was in underweight to the high yield asset class. From the top down, it was a pretty difficult year for fixed income. Two main reasons: rates were extremely volatile over the year, and the lower quality credit, meaning the lowest rated credit companies, outperformed over the year. And I'll get into greater detail over the future slides. Just for this slide, I'll note one more data point on the the trailing 7-year number. We are in line with the policy number for total returns over the fiscal year, and that's inclusive of the difficult year we had in the past 12 months. Slide 15, Gary. So overall, fixed income underperformed the benchmark. Before mentioned, the underweight to high yield was a big factor. There's a couple structural considerations as the policy allocation increased by 50 basis points at the start of the fiscal year. So with the benchmark, you turn the calendar, you're up 50 bips. So you either have to front run that in your portfolio or kind of catch up. Additionally, we had an ongoing RFP to add some new high yield advisors, and we were hoping to sort of use the allocation to these new advisors, and we hoped the timing would work to kind of up the asset class, and the timing was off a little bit. And lastly, I'll just mention we did have a cautious view of high yield for good reason heading into the year, with concerns of the economy slowing, which ended up not to be the case. The next three bullets I'll address in the interest of time. I'll address them in the future slides, but I'll just take you to the bottom in blue to quickly talk about looking ahead to fiscal year 25, which we're actually already 4 months into. So we believe, and this is happening the first 3 months of the fiscal year, the higher for longer premise has held, which is an attractive carry for fixed income. There's four components that kind of have to hold for this thesis to maintain. One being moderating growth, and by moderating meaning not deteriorating growth. The continued disinflation, continued rate cuts, which we received 50 bips of rate cuts in September already. Consensus would say 1 to 2 more this year and 3 to 4 next year. So we'll see how that plays out. And lastly, just the continued support of flows and fundamentals into the rates and credit markets. Slide 16, please, Gary. So slide 16, this is market data, not the portfolio. These are the indexes. So on the top left chart, you can see that high yield was the big outperformer in absolute terms, and long treasuries was a large underperformer as the treasury curve yield steepened over the year as growth expectations surprised to the upside. over the year. And the short end of the Treasury curve was actually stayed kind of pinned as we had expected rate cuts to happen over the year. On the right, the before mentioned credit quality outperformance. You could see that CCC outperformed general high yield by 150 basis points. And additionally, really the elephant in the room is the below CCC sleeve, which performed about almost 30% over the fiscal year, which were under allocated to that for good reason. Slide 17, please, Gary. So the Treasury portfolio did outperform over the year by 31 basis points. It's a very, very, very volatile year. The first quarter rates were higher. Treasury prices were lower as inflation edged higher and growth surprised to the upside over the year. There was a quick pivot in the second quarter in late October as the Fed had a pivot and the market quickly priced in 7 rate cuts by the end of the year. You could see tremendous performance there from October to December. So this portfolio had outperformed during Q1 and Q3, where the TIPS exposure provided protection in the rate backup periods. 18, please, Gary. The investment grade portfolio. Normally, my colleague Phil, the portfolio manager, would cover this, but in the interest of time, I'm just going to do all of the fixed income. So this is the largest portfolio in the fixed income composite. It's around $5 billion, all managed internally. There was slight outperformance over the year. Mostly, we had a long duration profile relative to the index, which hurt us in Q1 and Q3. And then in Q3 from October to December, where we had that beta rip, we were long duration, but actually the composition of the duration in the portfolio was overweight the higher quality names as opposed to the lower quality names. So all in, we underperformed. Slide 19, I'll actually skip if there's no questions on in the interest of time and go straight to slide 20, please, Gary. Slide 20 is the high yield portfolio. The before mentioned below CCC outperformance and below CCC outperformance. So we had very strong absolute returns, relative returns, a little disappointing. I'll mention sort of from a fiduciary perspective, a public pension plan, it sort of behooves us to kind of be under allocated this below CCC part of the market, it's less than 2% of the index. It just happened to be a year where this stuff really outperformed a great deal. And, certain very troubled credits, went from like a $40 price to $60 price, had tremendous returns, but there's still difficult situations, which we try and stay away from. And my last slide, 21. So the cash management fund, which is also a component of the fixed income asset class, we manage the cash in the pension plan. It's a really good year, a great place to be over the fiscal year. The short end of the curve provided very stable returns over the fiscal year, and the CMF fund was able to outperform via security selection versus the index, which is the 3-month T-bill, with investments in commercial paper, certificates of deposit, as well as different trades along the short end of the Treasury curve. So that concludes the fixed income portfolio. I'm happy to take questions. Otherwise, we can move on to the private markets.
I have just a quick question. What kind of a return are we getting on our cash portfolio?
So this year, we returned over 5%, which was tremendous. So going forward, we had, you could expect maybe like a 4% return over the next fiscal year. Again, it depends on the rate cuts. You really just get the carry as rates come down, you just get, that carry going forward. So it's a pure carry trade. So it depends on the rate cuts we see over the next fiscal year.
Chair Roger, we get 4.83 roughly right now in the stiff. If the Fed does what the market anticipates they do, and they cut 25 in November and then 25 in December, like Kevin said, for the full year, we're penciling out somewhere in the low 4s for our cash.
Great. I mean, maybe, it's maybe don't have to spend too much time on this, but the rates were sort of coming down, and then the Fed cuts. and then the rates have gone up, right? And they've gone up quite a bit from the bottom, right? I mean, they must be up, what, 70, 80 bips or something like that. How do you explain that? And what is the, just, you know, a very short comment on the outlook for that?
Sure.
I
So, you know, I think maybe, and Bill, maybe you could step in. I'll comment real quickly. But so growth expectations, you know, you could say they sort of, the Fed, you know, there's a thesis that the Fed did not need to raise rates to the extent that they did over the fiscal year of over 500 basis points. So it's sort of you could lower them now into a catch up, and the economy it's moderating, right? So it's not deteriorating quickly, but it's kind of slowly coming down. And they did the 50 bips in September, kind of caught some people off guard, and I think maybe that's part of you know, the long end is backing up due to, you know, some people say upcoming election. Part of that is the Trump trade with stronger dollar and higher rates on, you know, tariffs and things like that, and then just continued growth. And Bill, I don't know if you had anything to add.
That summed it up well. It's a number of variables. You've got the term premium being built in because of deficits. You've got concern over inflation picking back up, given the aggressive 50 bips cut on the front end. That could stoke the economy to start to heat up again, which could raise inflation concerns. We got a third quarter GDP number today, which the economy continues to do quite well. So I think all those things are adding up to moving the rates higher.
Yeah, thanks for that, and thanks for navigating this portfolio through all the volatility in rates. And I appreciate the point about staying away from the really, you know, triple C kind of credits. So I think on a risk-adjusted basis, once again, you know, very good performance. So thank you.
Thank you, Chairman.
Thank you, Chair. Thank you, Kevin. So if Chair, if you're okay with it, and if there aren't any other questions from council members and others, we'd like to proceed over to the private market asset class and turn it over to Bill and then the rest of the team. Or
Great.
some of the team members.
Thank you, Sean. I'll just spend maybe 30 seconds on this slide on page 22. The key things to note are the underweights versus the target allocations across the board. We're underweight all of our private asset classes, specifically real estate and private equity. Then I would point to the 7-year returns for the private markets. It's varied over the years. Obviously, with diversification has helped, but having exposure to the private markets has been a net positive contributor to the overall pension plan, especially with our 7% hurdle rate. So I just want to make that note. With that, I'll turn it over to Dana Johns for a discussion on private equity.
Thank you, Bill. Good morning, Chairman Raj, Vice Chairman Leibtag, and members of the SIC. Today, I'm pleased to share a brief annual review of the private equity portfolio. As of June 30th, 2024, the market value of the private equity portfolio was $7.7 billion, with an allocation of 11.04%, which is under the policy allocation target of 13%. Fiscal year performance was 2.36%, which is under the benchmark performance of 6.89%. A key driver of the underperformance for fiscal year 2024 was due to a few of the larger private equity fund manager relationships underperforming versus the benchmark. This short-term performance issue is offset by these fund managers and partnerships being our top performers on an inception to date basis. Together, the top 10 largest manager relationships represent more than 50% of the total program. They have outperformed relative to the entire private equity portfolio and other GP relationships across all time periods. Overall, 50% of the funded portfolio is generating first and second quartile returns by IRR and TVPI, driven by strong performance in venture growth, large buyout, and co-investments. Our diversified portfolio remains cash flow positive despite the slower exit environment that GPs and other LPs have experienced over the past few years. And this has been a very productive year with commitments to 12 new and existing private equity fund managers totaling $2 billion. Looking forward to 2025, we will continue to allocate in line with our commitment pacing to primary funds, our managed accounts, secondaries, and co-investments. In conclusion, while the private equity portfolio has faced challenges driven by the legacy portfolio, it is well positioned for growth and performance as we leverage our diversified investment approach, strong cash flow, and future commitments in top performing managers. Thanks for your attention. And if there's any questions, I'd be happy to take them now or pass it along to the private credit team.
Thank you, Dana. Any questions from the committee members? Great. Thank you very much.
Thank you.
Thank you, Dana. We can go to Brad Johnson for the private credit presentation.
Vitaly Smirnov is going to. present
Vitaly,
for the
okay.
private credit.
Okay, sorry. Vitaly,
Sorry.
if you would, please.
Good morning, Chair.
Good morning.
Good morning, council members. Good morning, partners and colleagues. We're on page 25, private credit. What this page shows is a consistent outperformance of the New Jersey private credit portfolio over the long term, which is 5 and 7 years trailing. For the fiscal year 2024, the portfolio returned 10%, which is in line with our expectations. We, however, are about 200 basis points behind the benchmark, and that is what I would like to explain. Next page, please. Page 26, private credit portfolio underperformance on a relative basis could be explained by a single factor: public markets volatility. New Jersey private credit portfolio consists of about 50% of true private credit investments and another 50% of public credit investments. While the benchmark we use is based on public markets, it's high yield with a 1-month lag. Public markets, by definition, are more volatile than private markets. And here I would like to reiterate that over the long term, 5 and 7 years trailing, New Jersey private credit portfolio has consistently outperformed the benchmark. Now, as for portfolio positioning, we made some adjustments through the year. We reduced exposure to structured credit. We increased allocation to direct lending and opportunistic credit. We made some additions to the portfolio. We upsized an existing account with a direct lending mandate. We made an addition to a global opportunistic credit strategy manager, and we re-upped with a European direct lending manager. In fiscal year 2025, we are looking to expand our exposure to asset-based credit and investment-grade private credit. Next page, please. Page 27, key points here are: outlook for private credit remains positive, albeit down from peak levels. Demand for private credit is strong, and private credit is as an asset class remains a formidable competitor to public markets. With that, please let me conclude and open the floor for questions. Thank you.
Thank you, Vitaly. Any questions for Vitaly? Private credit? Chair, if you're okay, we'd like to move on to real estate with Kevin Higgins, unless
Yeah,
there are
thank-
questions.
Yeah.
Okay, thank you, Vitaly. Appreciate that. Kevin, if you would, please.
Oh, thank you, Shahab. Good morning, Chair and members of the SIC. As the performance summary illustrates, fiscal year 24 performance was effectively flat and outperformed the real estate benchmark by nearly 1,200 basis points. We also outperformed our benchmark over trailing 5, 7, and 10-year periods. If we turn to the next slide, we can outline the drivers of performance. The real estate sector in general, and our benchmark in particular, have been negatively impacted by market disruption and asset repricing following the Fed's unprecedented raising rates. Our outperformance is driven by portfolio construction through strategy, property sector, and structure. First, strategy. Our benchmark is comprised of open-end core strategy funds. We focused on non-core strategies where we can earn higher risk-adjusted returns over the longer term. 60% of our private portfolio is comprised of value-add and opportunistic strategies. Second, property sector selection. Our benchmark has over 17% office, and we are 1/3 underweight, so we've not been as impacted by the office value reset. Our benchmark is more than 10% retail. We are more than 50% underweight, so we were not as impacted by the reset in mall values. We've benefited from non-traditional property types, things like self-storage, data centers, medical office, and life science. Third, we have exposure to public REITs. Strategically, we gain exposure to property types that can take longer to build in the private markets. Tactically, we lean into the public markets to take advantage of disruption and overcorrection. Looking ahead to fiscal 25 and beyond, we continue to focus on assets that are driven by long-term demographic and secular trends, and assets that have reduced correlation to economic cycles. We are positioning the portfolio to take advantage of asset value reset with managers who have strong track records of navigating turbulent markets. Also, we have a renewed interest in real estate debt. We've not been active in credit since 2016 because returns were anemic, but we now look for opportunities to earn near equity returns, both IRR and multiple, from superior positions in the capital stack. I'd also like to highlight that our real estate portfolio is mature and continues to generate cash flow for the pension plan. Real estate's been cash flow positive each fiscal year since 2013. And if there are any questions, I'll be happy to ask them.
Any questions to Kevin? Thank you.
Thank you, Kevin.
Thank you.
Appreciate it. Let us now move on to real assets, and I'd like to have Neeraj.
Thank you, Shoaib.
Thank you.
Good morning, Chair, and council members, and all attendees. The real assets ex-real estate portfolio delivered 2.36% versus, sorry, I apologize, that's the allocation number. The portfolio delivered 2.71% versus the benchmark of 7.17% in the past fiscal year. We are in year 4 of turning around this portfolio and transitioning it from a commodities book to a broader real assets book. We're pleased with this fiscal year's performance because the portfolio delivered stability, resilience, and distributions, which I'll cover in the next slide. We can move to the next slide. Thank you. So from a returns versus benchmark perspective, there's a bit of a mismatch ongoing because we continue to try to reduce the portfolio's exposure to legacy upstream oil and gas, legacy upstream metals and mining investments, whereas our blended Cambridge benchmark continues to have that even now in a significant amount of exposure. The new investments we've made towards infrastructure, towards energy transition since 2021 have continued to deliver. For example, if CPFA is used as an imperfect proxy for these new investments, during fiscal year, these new investments delivered approximately 12% IRR. We have also received elevated distributions this fiscal year, largely from our legacy conventional energy investments. We saw a 7.7% increase in net cash flow from these areas, and the entire asset class was also net cash flow positive, again, in this fiscal year. So that is commendable because the asset class continues to be deep in the J curve as it tries to build towards its allocation target of 3%. One last point to mention as far as the mismatch goes, there continues to be approximately 7% of the portfolio in one SMA that continues to drive both gains and losses. Some of these assets should be in real estate, some of these assets should be in private equity. Not all of these assets have performed. 230 Park Avenue is an example. That was a complete write-off. So that also contributes to the portfolio performance and the continued mismatch versus the benchmark, because the benchmark has no real estate in it, for example. What's the future outlook? This is one of the most interesting and attractive times for the real assets ex-real estate space. Infrastructure and energy transition continue to be in high demand from LPs, given the resiliency these areas have shown in light of high and now cooling inflation and geopolitical uncertainty. We want to continue to build the asset class towards these areas while keeping an eye for other assets, for other areas of the broader real assets landscape. We want to continue to approach the opportunity set with a view that we will not be able to do every deal in the market. We want to do a handful of deals per year that are very high conviction alongside trusted partners, and that will help us navigate some of our internal execution challenges that continue to impact deployment, pacing, portfolio management, exits, and the entire continuum, if you will. So to that point, we continue to want to build the portfolio up on the co-investment side. Over time, we want the portfolio to be 50-50 between funds and co-investments. Co-investments get us better terms than fund commitments, but then they also allow us to control a bit of our deployment and execution. So more of the same in terms of trying to turn around and build up this part of real assets. I'll take a pause there, see if there are any questions.
That's a good analysis, Neeraj. We appreciate it. What is the exposure that we have in alternative energy in your portfolio now? Is there much exposure right now, or is that continuing to build?
Chair, do you mean conventional energy?
No, alternative energy.
Oh, renewables.
Renewables, right.
Sure. Yes, the exposure is minimal, but building quickly. We obviously have a trusted partner in Brookfield. We are alongside them in a fund and a co-investment sidecar. So it is minimal at this time, but growing intentionally. Yes.
Is there an objective to get to a certain percentage of the portfolio, at some future point?
We haven't set a target percentage simply because the opportunity set is so vast that the entire portfolio could be comprised of just that if we wanted it to. As we build the portfolio and we see deal flow, that's when we might think about thinking if we should put a limit on it, just because the two main themes within the infrastructure world continues to be renewables, energy transition, digital infrastructure. So we haven't put a limit yet, just because the portfolio is still in build mode, and we continue to see how the market evolves.
Great. Yeah, keep us apprised on the developments there. Thank you.
Absolutely. Any
other questions for Neeraj on private assets? No, or real assets, sorry. Okay, there being none, thank you, Neeraj. We will now turn it over to Jesse Choi to bring us home now. This is the last stretch, and we're going to be speaking about risk mitigation strategies portfolio. So Jesse, over to you.
Thank you, Shoab. Good morning. And like he said, this is a home stretch, so I'll try to make this quick as possible. During the fiscal year, RMS has returned 10.8% versus 8.6% for the benchmark. The 220 basis points of outperformance was attributed to macro and event-driven strategies. And over the long term, the portfolio has outperformed its benchmark across all 5, 7, 10-year trailing periods. If you can go to the next page, Gary, please. RMS continued to protect capital and delivered uncorrelated returns during the equity market sell-off throughout the year. For example, from August to October of 2023, the RMS portfolio returned positive 2.9% versus negative 9.6% for ACWI, as geopolitical risk in the Middle East and fears over rates caused the markets to be highly volatile. That's 12.5% of outperformance. Some of the key factors that impacted relative returns include risk-on themes in the macro portfolios, including exposures across equity, fixed FX, and commodities. And looking ahead, we see a very promising outlook for continued above average alpha opportunities. And this is mainly due to broad macro uncertainty that remains from changing interest rate environments as central banks across the world transition from raising rates to lowering rates in the US, and as well as geopolitical tensions in Europe and the Middle East continue. Not to mention elections at home in the US and in Europe, which could lead to very different policy outcomes. This highly uncertainty and market volatility should lead to favoring active trading strategies, which can capture dislocations in fair value. And tying that to our portfolio, RMS has reduced its beta over time, and this should position the portfolio well in providing greater downside protection when volatilities do come in a large way. That's the end of my presentation and performance remarks. I'll pause here for any questions.
Thank you, Jesse. Yeah. Any questions for Jesse? Great. Thank you very
Jesse.
much.
Appreciate it. Thank you. And thanks everybody for all the hard work that's gone into generating the results for fiscal year 2024. Of course, the hard work continues, and we hope to be back next year with some good news. Markets so far have been cooperating, as we've seen. We continue to be cautiously optimistic and continue to work hard every day. So thank you, and thanks to the entire team. So I think, Chair, one of the things that sort of comes out from having listened to each of the asset classes and looking at the performance dispersion is the value of having a diversified portfolio. And as we've seen, there have been years when we've talked about, and certainly this is one of those, where public markets have delivered stellar performance. There have been other years when private markets have delivered stellar returns and 20+% returns for private equity and other strategies and so forth. And even within private market asset classes, we see the dispersion with risk mitigation strategies and private credit and so forth delivering double digit, whereas others haven't. So I think this is the value that a diversified portfolio brings to the table, and certainly for a public pension plan that is looking to manage cash flows, that's looking to manage volatility and have a well-balanced portfolio, I think we are well positioned to meet those goals. So no further comments from me on this side. Unless there are any questions, we can just move on to the next item, but let me pause there for a second if there are any questions. Okay.
Any questions from the team? Yeah, so I just wanted to have a quick time check, everybody. I think we are very nicely ahead on the time side. I think we probably can finish the meetings, closer to 1 o'clock. It looks like than 1:30. So if it's okay with everybody, I think it doesn't seem to be a burning need to take a break, if that's fine with everybody. So rather than taking a break, we can just battle through this and try to finish in that kind of a time frame, if that's okay with
Chair,
us.
can I add one more item, just to close the
Yes,
loop
please.
on my section, and before we go to break, if you don't mind, I would just like to mention on agenda item 6D that we, after this, and typically this is how we do this, where we wait until the fiscal year unaudited returns are disclosed for June 30th, and then we publish the June, July, and August monthly reports onto our website. So I just wanted to let everybody know that we will be doing that now that we have made these presentations to the SIC. So I just wanted to make you aware of that. And absolutely, Chair, if you'd like to go to a break, we certainly can. We are indeed ahead of our estimated time, which is obviously a good position to be in. So how long would you like the break, and when would you like us to?
Yeah, I was actually suggesting no break, if that's.
Oh, okay. I'm sorry.
Okay. And is that are there any nods from I can't see everybody on camera. So if that's okay, I think we can probably just go through and finish up by 1 o'clock, if that's okay.
That's fine.
Sounds good. Okay. So let's move ahead and sure we can move to the NJ Best and FT 529 portfolios discussion.
Okay, thank you, Chair. So maybe just a quick introduction on this. So this is something that this is a presentation that'll be made by the Franklin Templeton team. This is for the NJ Best and the Franklin Templeton 529 portfolio. Just a little bit of background on this. The New Jersey Higher Education Student Assistance Authority, HESA as it's often known, is the program administrator for this. And Franklin Templeton is the program manager as well as the investment manager. They have certain updates as well as bringing some changes, interim changes at this point, and then we'll probably be bringing it back at the next IC for some longer term changes as well for updates to the SIC. Lisa Walker and Ed Pittman have been working closely with HESA on these. So with that said, I'd like to turn it over to the Franklin Templeton team.
Great. Well, thank you. Can you confirm you can hear me?
We can.
Okay, thanks a lot, and thanks, Chairman, and the committee for having us on today. And I also like to thank our partners at HESA and DOI for the overall partnership and in collaboration, and as we all have the objective of helping New Jersey 529 investors save for their education goals. If we can turn to slide 2 to kick it off. Well, before I get into the slides, my name is Brendan Burns. I'm a solutions portfolio manager within FT Franklin Templeton Investment Solutions, which is the investment manager within Franklin Templeton that manages these 2 plans. I'm joined by Tom Nelson and Berkeley Belknap, both portfolio managers on the 529 portfolios. And I just quickly wanted to review the last time that we were in front of the committee was in 2022 when we had approved some enhancements to the program. And I'm really happy to report since that approval, we've seen truly exceptional performance from both plans' portfolio performance. The NJ Best Direct plan ranks in the top quartile of its peer group rankings on an average basis across the 3 risk-based glide paths, and the advisor plan, the NJFT advisor plan, is in the top 3rd. If you look at where the assets are actually, most of the assets are in the growth risk-based glide path, and those portfolios across the board are top decile performers, and a lot of that is a result of the enhancements that were implemented in 2022 and are beginning to get industry recognition. Just last month, Saving for College rated the NJ Best top of class rating and the NJ FT 529 program high honors. And hot off the presses, just yesterday, Morningstar upgraded the NJ FT 529 program. So thanks for the collaboration. These enhancements that we all work together are working, and we're seeing that come through in performance and ultimately improving the education savers experience. If we want to turn to slide 4, what we want to do is spend the next 8 or so minutes on the enhancements that we're proposing today. And these enhancements are really designed to be an evolution of what we had started in 2022 and further improve upon those enhancements. I would say the key themes that we're proposing, or that led to the enhancements that we're proposing, are modernizing the program, simplifying the program, and further reducing fees for education savers. Like I said, we manage 2 programs. We manage them very similarly for the most part. Each of the programs has 3 portfolio options. They're glide path portfolios, they're objective-based portfolios, and they're single fund portfolios. And we're proposing some structural enhancements and changes to each of those categories. In the glide path, we are proposing a simplification from 3 risk-based glide paths to 1 single glide path. And in doing so, moving from an age-based program to a target year program. And I'll get into some more details on this in the following slides. On the objective-based portfolios, we are simplifying from 6 risk-based static portfolios to 3. And then on the single fund options is where we'll see a little bit of deviation between the advisor and the direct plans, where we are simplifying the direct plan, simplifying and improving the direct plan, and retaining most of the options in the advisor plan, though making some underlying strategy changes to improve the investment lineup. If we turn to slide 5, just to quickly review the glide path enhancements. On this slide, you can see the 3 risk-based glide paths that we have today. Those are the ones that have the stepped motions. We are proposing transitioning to a single progressive glide path, and that's the one shown in purple. That is a more smoother line. We believe that this improves the investor experience by more smoothly shifting from equity and higher risk asset classes to fixed income and lower risk asset classes as the investor moves closer to their education target period, enrollment period. We are retaining, for the most part, the growth glide path. We believe that in the long term, investors benefit from equity market participation. As you can see here, our glide path starts at 100% and systematically moves down to approximately 15% at enrollment. This is fairly similar to what you would see from your 401k target date fund, where your allocation shifts from equity to fixed income. In addition to the smoothing out of the glide path, we're also implementing these portfolios in target year portfolios. So an investor invests in one portfolio for their child at birth, or whenever they choose to open their 529 account, and that child moves with this single portfolio throughout the life of their savings goals, as opposed to the prior structure where the child would move as they aged. We believe that this significantly enhances the investor experience by allowing them to more easily and more transparently follow their portfolio experience over the long term. If you want to turn to slide 7, this further brings that to life. And as I mentioned, we are transitioning from an age-based program to a years to enrollment program. And I'll focus primarily on the bottom of the slide, the growth section, which is where you can see the allocations in the portfolios that all of the risk-based glide path portfolios will be mapped to. And here you can see target 2020 or target 2041 down to target 2025 portfolios, and then finally an enrolled portfolio. This is intended to allow an investor to select the year that they intend to enroll their child and start using their education savings. This is a much more simplified process, one that's more aligned with how most investors invest in their 401k, and probably are more familiar with that style of investing. There will be 10 portfolios that we will systematically move from equity to fixed income as the portfolio moves closer to enrollment. Turning to slide 9, very quickly touch on fulfillment. For the most part, we aren't making significant changes to the fulfillment of the underlying glide path portfolios. I will point out that early this year, Franklin Templeton completed an acquisition of Putnam Investments, a leading asset manager. We are adding some Putnam investments in the program, and here you can see on the right side of the slide the proposed portfolio versus what we currently have on the left side. And in green are new strategies. We're adding the Putnam Large Cap Growth and Putnam Large Cap Value. I would say those are the most meaningful changes. Both of those funds are industry-leading equity funds, top class performance, and we believe will further improve the performance experience for investors. Secondly, you'll notice that there are several strategies that have their strategy name highlighted in green. We are transitioning several mutual fund holdings into separate accounts, and this is specifically designed to maintain the overall active allocations within the overall 529 portfolio, while providing investors some fee relief in our 5-year commitment to lowering fees for investors. And at the very bottom of the slide, you can see the estimated weighted acquired fund fee impact that these changes are estimated to have, reducing fees by 3 basis points. Over the last 4 years, we've reduced acquired fund fees by over 60% for New Jersey investors, and this shows our continued commitment in providing New Jersey 529 investors with best-in-class active management, as well as a very fee-efficient vehicle structure. If we turn to slide 10, this is where I will review the static asset allocation portfolio enhancements. Here we are, as I said earlier, we are simplifying the program from 6 risk-based portfolios to 3. One of the things that we find in the 529 industry is, sometimes the hardest thing for investors to do when investing in a 529 program is to actually open their account and then select their investment options. What we're trying to do here is simplify that process for investors to select what portfolios are best for them. Investors overwhelmingly select higher equity portfolios when given a cohort of asset allocation portfolios. What we're doing in this enhancement is retaining 3 balanced portfolios that range from 50% equity to 100% equity. Now, the 3 portfolios that we are sunsetting, those investors still have a place in the program. We have dedicated all fixed income single fund strategies that will map the more conservative investors into, as well as a fixed income heavy asset allocation portfolio on the glide path that those investors will go to. The objective here is to simplify the program, but not lose any of the optionality for New Jersey investors. And then lastly, if we turn to slide 12, I'll quickly review the single fund options. This slide reviews the NJ Best, the direct plan, the single fund enhancements. So currently we are offering 14 single fund options that are very asset class and style specific. Feedback that we've received from both HISA and as we've seen in the industry, direct plan investors really value simplicity. So what we're providing in this proposal is a simplification of the single fund option from 14 options down to 7 options. And those 7 options retain all of the asset class core exposures that were provided in the current option, but in a much more digestible and user-friendly way. We still have large cap growth, we still have large cap value, we have a U.S. large cap index fund, an international index fund, an international active fund, and core fixed income portfolios for investors to build their own custom asset allocation strategy. And then the last slide I will review is the advisor plan, the single fund advisor plan, which on slide 13, you'll see here for the most part, we're retaining most of the equity strategies, transitioning some of the U.S. equity to Putnam, which we think will improve the user experience. And then on the fixed income side, selling out of Western and providing Putnam core bond option. And then lastly, transitioning one of the ESG strategies from ClearBridge to Putnam that we believe is an upgrade from a investment management and performance experience. So I was essentially given 10 minutes to try to present what was a lot of work and a number of enhancements. I'm very happy to take any questions that the committee may have.
No, thanks very much. I appreciate it and appreciate all the work here. What are next steps here?
Yep.
What do we look forward to?
Yeah, so next steps, November is our target implementation for these changes, for most of these changes. The glide path portfolios, the static asset allocation portfolios, and most of the single funds will transition mid-November. Upon approval from the committee, and then the one strategy that will be implemented in Q1 is the ClearBridge Sustainability Leaders transition to Putnam Sustainability Leaders. That one requires a little bit more investor notification. That will be completed in the first quarter of the year.
Okay. Thank you. Any questions from the committee members? Otherwise, we can move on to the next agenda item.
Thank you, Brendan. Thank you, Chair. I think there might be a motion that's needed here for
okay.
approval,
Sorry.
Chair.
Good. Okay. So any more discussion, or we can move ahead to a vote? Good. And this was discussed in the IPC, and the IPC decided that this was a good way to proceed, I think, right? So
that is correct, Chair.
Yeah. Okay. So with that in mind, let's just have a.
Mr. Chairman? Yeah,
Sorry, please.
I know it's probably been discussed. I'm sure there's many of us, me included, to set up these accounts for grandchildren. But that's I assume that's not a problem. Correct?
Not a problem at all.
Not from you, Brendan. from the state ethics rules. Okay, I appreciate your jumping in.
We encourage it, but
I don't think we have any ethics problems. Does anybody jump in on that?
I don't know that we have the Judge. I don't think we have any ethics team members on this call. I think it would probably be wise, I think, to follow up with them and to see if that might potentially be an issue or not.
Okay, if we're gonna, Mr. Chairman, if we're gonna vote, I'm just gonna recuse myself then. I set them up for my grandchildren, so, the little, I better known as the little ingrates. No, I don't mean that. So, okay.
Well, quite. In fact, now that you mentioned it, Judge, I would say the same thing that you just did.
I'm sure you did, I'm sure we did.
So I've set up a plan for my grandkids as well. Let's see, what's the right way to do this? Is there a way, Director Khan, to do this by email in a week or so? Is Ruben on the call?
Pam,
Maybe we
yeah,
can get
Ruben
some
or Pam,
advice.
Pam has
You
been
can-
working pretty closely
Yes,
on this with Lisa and Ed as well. Pam, would you please chime in?
We can't, you can't vote by email. You would need to call if you needed to delay for some reason, we'd need to have a special meeting.
Special, okay,
But there's no allowance for a vote.
got it.
Yeah,
Okay.
fortunately.
So in the interest of time, then, I mean, perhaps, the judge and I can recuse myself. I can turn it over to Vice Chair Leaptag.
Great.
And then you can, and you can have a discussion and a vote.
I appreciate it.
You proceed that way. Pam, is that okay?
Yes, I think it is, so long as we still have a quorum, I think.
Quorum, right. And I believe we do. Ernestine, is that correct? We
That's
would
correct.
still have a
We have-
quorum?
Yeah, we have a quorum.
Okay. All right,
I would
Chair, if
need
you'd
to
like to turn
recuse
it over to-
also, Ed Yarshinsky.
That's fair. If we could just do a motion in a second, and then we'll do the roll call and for quorum.
So moved.
Mr. Aronson made the motion to approve the plan as presented. I'll second. Ernestine, could you please call the roll?
Sure, Mr. Aronson,
Approve.
Mr. Bore, did you ever join? Mr. Bruno? Mr. Bruno had to drop off. Mr. Carr,
I oppose.
pose. Noted. Mr. Cleary,
Approve.
Mr. Crow. Mr. Crow, are you with us? Mr. Greenie, Mr. Hanson?
Approved. Ernestine, I apologize. This is Vaughn Crow and I approve.
Excellent. Thank you.
And I
Mr.
approve. So if you got that, sorry.
Mr. Hanson, I got it. Mr. Leaptag,
Yes.
Mr. McGuckin,
Approve.
Mr. Pandieri,
Approved.
Mr. Raj, you want to state for the record?
I will abstain, yeah.
Mr. Richard,
Yes.
Mr. St. John,
Abstain.
and Mr. Yarensinski.
Abstain.
Motion carries.
Good,
Okay, thank you. Thank you, Ernestine.
Sure.
thank you.
Thank you, Brendan. Appreciate the information.
Thanks, everyone.
Thank you.
We'll drop off at this point.
Great,
Thank you very
Okay,
much.
thank you.
So Chair, that's agenda item 7. If you'd like to continue, we can certainly move on to agenda item
Yes.
8.
Right,
Okay.
that'd be great. So let's move on now to the investments that have been proposed by the division. We have five investment proposals. Can we start with the EQT infrastructure 6 and the sidecar real assets under the real assets as a class? I would now invite Neeraj Agarwal from the division to present this agenda item. We'd also have with us Nick De La Rora from Axia's investment diligence team, Daniel Burdett from the Axia operational diligence team, and Michelle Davidson and others from the Axia's advisory side, in case the council members would like to hear from them. So over to you, Neeraj.
Thank you, Chair. This investment item will sit within the real assets X real estate portfolio. It is a re-up, and we would be coming into EQT Infrastructure Fund 6. The fund commitment will also have a co-investment sidecar that will be similarly sized. And we were able to get a very good outcome on the sidecar after extensive negotiations. I'll let Ryan Goodwin on my team walk through the opportunity.
Yeah, thank you, Niraj, and good morning, members and chair. Today, we were proposing a $200 million commitment to EQT Infrastructure Fund 6, as well as a $200 million commitment to a co-investment sidecar vehicle. The pension fund first invested with EQT Infrastructure in 2021 with a commitment to Fund 5. And Fund 6 is a continuation of the strategy, which is a global value-add diversified infrastructure fund focused primarily on the European and North American markets. The fund will invest in various sectors, including digital, energy and environmental, transportation and logistics, and social infrastructure. The fund is targeting net mid-teens returns and a 20 billion euro fund size with a 21 billion euro hard cap. Founded in 1994, EQT is a global investment firm focused on private equity, infrastructure, and real estate. And they're based in Stockholm, Sweden. They have around 246 million euros in AUM. The investment thesis with this investment revolves around a few key points. Firstly, EQT has a strong track record. The firm's value-add infrastructure funds have returned a net 16% IRR with a loss ratio of 1.5%, highlighting strong but consistent returns. And further, the team has exited approximately 40% of their investments to date across the fund series, proving the team's ability to generate and distribute returns back to investors. Secondly, the fund's differentiated strategy leads to a strong portfolio fit for the pension fund. With this commitment, the pension fund will be able to increase its exposure to infrastructure sectors with strong tailwinds for growth, with investments in data centers and renewable energy, which will help diversify the real assets portfolio away from its legacy traditional energy investments in oil and gas. And further, the fund will help increase exposures to Europe and developed Asia. And as Niraj mentioned, the division negotiated a sidecar vehicle to invest alongside the fund, which will help reduce fees and allow for a more tactical build out of the real assets portfolio. Third, the fund is backed by an experienced and tenured management team. So Leonard Bletcher, who founded the EQT infrastructure strategy back in 2007, remains with the firm as the head of real assets. And the fund is led by Masoud Homayoun, who joined shortly after Leonard in 2008. The team includes 24 partners. 12 of them have been with the team since Fund 1, which highlights the strong retention, cohesion, and the team's overall experience. The team is further supported by over 100 investment professionals, and that has grown in line with the strategy's growth. And finally, the EQT's ESG policies and processes were reviewed by the division's corporate governance team. The firm has a strong ESG framework that goes into, investment decision-making from start to finish. Regarding the key terms of the fund, the term will be 12 years with 3 one-year extension periods. And the investment period is 6 years from the final close date. EQT will be committing a minimum of 1% to the fund in the form of a GP commitment. The pension fund will pay a management fee of 1.5% on the commingled fund commitments versus the standard rate of 1.65%. The carry is 20% over a 6% hurdle, with the waterfall being 90% European and 10% American. The co-investment sidecar will incur 0 management fees or carried interest fees. And finally, the division was able to negotiate an LPAC seat. That concludes our prepared remarks. We'll take any questions you may have. Thank you.
Yeah, thank you, Ryan. What is the geographical mix of these investments now or proposed? North America versus Europe versus emerging markets?
So typically EQT's infrastructure fund series will primarily be North America and Europe with a tilt towards Europe. A small percentage of the latest couple of funds have been into developed Asia. So we expect that to continue here. There's a cap on developed Asia at about 20%. So
good. Okay. So Europe and US are the two main geographical regions here.
Yes.
Okay. Good. Thank you. Any other questions?
Chair, if I could just follow up on your previous question you asked about energy transition or renewables within the real assets portfolio. Suzanne Hannigan's done a lot of work on trying to parse this out. Within real assets, it's approximately 21%. And across our privates, it's about 4% or so. So I just wanted to come back and let you know that.
Thanks for that, Bill. Appreciate it.
Seems
okay,
like
so no
questions, Chair.
No questions of EQT, right? So I can report that the Investment Policy Committee reviewed due diligence from the staff for this proposed investment and recommended that it be presented to the council. Good.
Thank you, Chair. Thank you, Ryan. Thank you, Neeraj. Appreciate that and excellent work.
Thank you all.
Thank you very much. We would like to now move on to Neuberger Berman.
I need to recuse on this.
Mr. Chair, this is Vaughn Crowe. I will also recuse and step off.
Hanson and Mr. Crowe duly noted.
Okay, so
I'll shoot you an email. I'll shoot you both an email when to rejoin, okay?
Perfect. Thank you.
Okay, thank you, Mr. Hanson. Thank you, Mr. Crowe. Dana Jones from the division will be presenting this the Neuberger Berman idea. And over to you,
Actually,
Dana.
Chris Goodman from my team will be presenting.
Okay.
I asked him to turn
Welcome, Chris. Yes.
video on.
Yeah, just before you
Okay,
start,
there it is.
Chris.
There we
Yeah, I would just want to also mention that we have the Axia team, with us. Tom Hubbard, Suante Williams, Michael Calabrese, and of course Michelle Davidson. In the event we have any questions for them. So sorry, please go ahead.
Yep. Good morning, Chairman Raj and members of the SIC. I'm Chris Goodman, a member of the private equity team. The private equity team is recommending a commitment of up to $300 million to the Neuberger Berman, New Jersey Custom Investment Fund 4, a separately managed co-investment fund. Neuberger is a longtime partner with New Jersey beginning in 2007, and since 2012 has been a key partner in building the private equity co-investment program. Neuberger's private investment portfolio and co-investment team, or PIPCO, was established in 1981 and manages many custom private equity programs for public and private pensions, insurance companies, and sovereign wealth funds. Neuberger Berman leverages their GP relationships across hundreds of active fund investments in their primary funds and secondary funds business. Co-investments are a significant feature of the NJDOI private equity program and are meant to capture alpha, reduce fees, and mitigate the portfolio J-curve. This co-investment SMA, like the prior two vehicles, will have 15 to 25 co-investments with equity checks ranging from 10 to 25 million and target returns of 2x gross MOIC and 20% gross IRR. PIPCO will construct a global diversified portfolio of direct co-investments with flexible investment mandates through co-underwrites, traditional, and midlife co-investments. These diversified co-investments provide attractive risk-adjusted returns and are diversified across industry and geography. Fund 2 is generating top quartile performance for all metrics against the Burgess buyout benchmarks, and Fund 3A is above the median on both TVPI and DPI. Fund 3B, vintage year 2021, is a young portfolio, and the companies are performing well and to plan. Through continuing this partnership with Neuberger Berman, NJDOI will capture the benefits of co-investments, which include decreasing fee base, increasing alpha potential, and returning capital earlier. The partnership's risk-return profile will continue its complementary nature alongside our co-investment program partners, as well as provide continued access to the Neuberger co-investment team, who consistently generates outperformance and a strong distribution profile. The PE team confirms that the terms remain the same as prior separately managed accounts and are in line with industry standard for co-investment SMAs. These conclude my formal remarks. Happy to take any questions at this time.
Any questions from the committee members? Okay, thank you very much. I can report that the Investment Policy Committee has reviewed the staff's due diligence for this investment and recommended that it be presented to the council. Thank you very much.
Chair, I'm going to invite Hanson and Crow back to rejoin.
Okay, great. Thank you, Ernestine.
Thank you, Chris.
Thank
you, Dana.
So let's now proceed to JLL Partners, Private Equity Fund. Again, back to you, Dana. We also have the Axia team who had joined us for the previous discussion. So over to you.
Thanks so much. And today, Guy Pesercia will be presenting JLL to the SIC.
Thank you, Dana. Good morning, Chairman Raj and members of the SIC. Thank you for being with us this morning. The private equity team has recommended a commitment of up to $200 million to JLL Partners Fund 9. JLL Partners is a high conviction existing middle market buyout manager in the division of investments private equity portfolio. The division has current commitments to the prior 3 JLL funds totaling $500 million. JLL Partners, a New York-based firm, was founded in 1988 and has invested 8 institutional buyout funds across multiple economic cycles. The JLL investment team has been consistent in its investment approach across the past 3 funds, building concentrated portfolios of 8 to 12 investments across 3 core sectors, with an average hold period of 3 to 5 years and equity checks averaging $120 million. Typical transactions will take the form of traditional buyouts, founder recapitalizations, corporate carve-outs, and buy and builds, with sector focus in healthcare, aerospace and defense, and business services. JLL will target returns of gross MOIC of 2.5x and net IRR greater than 20%. Like the prior 3 funds, JLL 9 will invest primarily in companies based in North America. JLL focuses on operational transformation to create platforms that have scarcity value at exit and are attractive assets for strategics and financial sponsors, which are the 2 typical exit paths. JLL has demonstrated consistent and strong investment performance across the past 3 funds. JLL's mature funds compare well to other middle market buyout funds across net, IRR, TVPI, and DPI. JLL is a strong performing middle market manager in the private equity portfolio, providing sector exposure to healthcare, aerospace and defense, and business services. The private equity team confirms that the terms for JLL Fund 9 are in line with industry standard for the private equity space. This concludes my formal remarks. We are excited about continuing this partnership with JLL Partners, and we are happy to answer any questions that you may have at this time.
Yeah, this is a question for Dana, I think, more than anything else. I mean, this is a fairly large percentage of the total fund that they are launching. right? I mean, we have about 20% of the fund.
Yeah.
Can you go into spend a couple of minutes? What gives you the confidence that for that kind of a percentage?
Sure. We've talked about this internally a lot. This is a manager where we have a strong partnership. We have actually negotiated a reduced management fee. So we were thinking about, how would we leverage, our the precious capital that we have to allocate. And this is one manager where they have consistently shown really strong performance and strong partnership. What we didn't mention actually was that we also get, we've had several very successful co-invests through Neuberger Berman with JLL. So we're kind of a partner of choice for co-invest. So we're also able to kind of manage down, even though it's through Neuberger Berman. We, are able to double down on, high performing portfolio companies in the portfolio.
Chair, I
Okay.
would just add to what Dana said and agreeing with everything Dana said. It is something that we watch very carefully. We continue, and of course, we want to manage risk appropriately. There are times when we will make slight exceptions to move the dial up a little bit when it makes sense to do so. And the firm is not raising a huge fund at this point, right? And so that also gives us conviction in the manager in that there isn't going to be a lot of capital to deploy, and therefore less likelihood of making mistakes in terms of looking to deploy large amounts of capital as well. And so that for those, as well as number of other reasons that Dana mentioned, is what, and of course, the historical relationship that we have with them is what provides the team the confidence to move forward with this. As Dana mentioned, as you know, we go into lots of detailed discussions, and this is really a summary of what comes out of it. There are obviously, as you know, reports and so forth, and we get into a lot of details, and that was one of the detailed discussions that we did touch upon as the diligence was being conducted.
I'm sure, yes. No, and I think we have under exposure to middle market. So I think if you have a good relationship, how long is the relationship here with JLL? When did it start?
Since 2009.
Okay. Okay. Any other points from the committee members? Okay, thank you very much.
Thank you.
I can report that the IPC reviewed the due diligence from the staff for this investment and recommended that it could be presented to the council. Thank you very much to the team.
Thank you, Guy. Thank you, Dana.
Thank you, Sean.
Okay, let's move on to the ICG European Fund. I would invite Jesse Choi to discuss this private credit investment. We also have from Axia, Leo Fletcher-Smith, Efolabi Oliver, and Michelle Davidson. So over to you, Jesse. Welcome again.
Thank you, Chair. Hello again. Good afternoon. You might have noticed a new face. I'd like to introduce you to Peterson Leonard, who joined the division 2 years ago as a trainee and has been elevated to an alternative analyst. He graduated from Muhlenberg College with a Bachelor of Science in Mathematics and a minor in economics. Wave hello. Before I turn it over to Peterson, I'd like to give you a short intro on the fund. ICG Fund 9 is a high conviction re-up to a blue chip junior debt fund focused in Europe, where we have a gap outside of the US exposure. So it is a complementary exposure to our existing private credit portfolio, and it will help us diversify our exposure. What's truly unique about ICG is the fact that not only is ICG Europe strategy investing in sponsor-backed deals, but also corporate deals, where they have been getting additional sourcing channels from family-owned businesses or backing management-led transactions. This resulted in a very consistent top quartile net returns over 30 years of successful investment track record. So with that, I will turn it over to Peterson to give you more details. Peterson?
Thank you, Jesse, for the warm introduction, and good afternoon, SIC board members. Today, we're recommending an investment of up to 200 million euros in ICG Europe Fund 9. In connection with this investment, the DOI has negotiated with ICG to roll up to 75 million euros existing unfunded commitment in ICG Europe Fund 8 co-investment vehicle to ICG Fund 9 co-investment opportunities. To set the stage, ICG is a global alternative investment manager founded in 1989, headquartered in London, UK. The firm manages 101 billion as of June 30th, 2024, with 640 employees. Fund 9 will have 36 dedicated investment professionals led by CIO, CEO Benoit Durantis, and will also benefit from the 70 euro focus executives. The strategy will invest in locally originated bespoke transactions in Western European markets, targeting mid-market and upper mid-market companies. This is ICG's flagship strategy that they've invested across 10 vintages for over 30 years. The investment themes will be centered around 3 pillars: corporates, sponsored LBOs, and opportunistic opportunities. And the strategy will invest flexibly across the capital structure through a blend of equity and debt instruments, targeting a 1.6x multiple net and 16% net IRR. To highlight a few investment merits, since inception, the Europe corporate platform has done 413 deals, delivering a gross multiple of 1.8x. The strategy continues to be top quartile, which is consistent with its prior vintages, and the strategy is a very senior team with an average of 20 years of experience and with a long, successful track record deploying the strategy. Lastly, on terms, the proposed fees are in line with Fund 8 and other similar strategies. Overall, ICG is a high-quality manager that delivers strong risk-adjusted returns, and an investment in Fund 9 would further support and diversify the private credit portfolio. We're excited about this investment and its positive effect to the pension. I'll stop here for any questions.
Yeah, my only question is that you have these net IRRs. These are in dollars or in euros? Do you know?
These are in dollars.
Dollars? Okay. So net of any currency shifts.
Yes.
Yes. Yes.
Any other questions? Okay, great. Thank you, Jesse, and welcome, Peterson. Appreciate it.
Thank you, Chairman.
I can report that the Investment Policy Committee had reviewed the staff's due diligence for this proposed investment and recommended that it be presented to the council. The last investment idea for today is Carlyle Realty Partners. We'll be hearing about this from Kevin Higgins to discuss this investment, so invite him back. We have from Hamilton Lane, Sean Barber, and Scott Davies, in case you have any questions for them.
And Chair, I believe we have another recusal, Mr. Kroll.
That's right, Director Khan. Mr. Chair, I will recuse and step off, and Ernestine, if you can let me know when to return, that'd be great.
Excellent, I will.
Thank you. Thank you, Mr. Crow. So over to you, Kevin.
Thank you, Chairman Raj and SIC members. I'd like to say we're restarting a relationship with Carlyle Real Estate. The division was an investor in Fund 5 in 2006. We stayed in contact with the Carlyle team and monitored the performance, and the timing of their latest fund aligns with our investment program and portfolio construction to take advantage of repricing and market stress opportunities. First, I'd like to introduce Adam Lubinski, who will provide an overview of the investment. But first, I'd like to mention that Adam joined the division about 2 years ago. He's a Rutgers grad with an economics background. And I'd like to say that his analytical skills have significantly contributed to the division's capabilities. So Adam, please proceed.
Thank you, Kevin. I really appreciate that intro. Good afternoon, everyone. We're pleased to present a compelling investment opportunity to our esteemed State Investment Council. So just to summarize, the division is recommending a $300 million commitment to Carlyle Realty Partners 10. This is the 10th fund in Carlyle Group's flagship opportunistic real estate fund series. The fund seeks to raise $8 billion in capital commitments and set a $10 billion hard cap. The fund aims to generate opportunistic returns for its investors, meaning greater than 20% gross IRR. Just for some background on Carlyle, the fund is sponsored by Carlyle Group Incorporated, which is a publicly listed investment manager founded in 1987 that is headquartered in Washington, D.C. Carlyle currently encompasses $435 billion of assets under management across a wide range of asset classes. Carlyle's dedicated U.S. real estate vertical was launched in 1997. Today, the real estate platform encompasses $28 billion of assets under management, more than 130 dedicated professionals. And so just to elaborate on each point of the investment thesis, Carlyle's U.S. real estate business has exhibited consistency and stability. Robert Stuckey has led the platform since its inception in 1997. The 130 professional real estate team includes 30 professionals at the managing director level and above. In aggregate, this group boasts an average of 24 years of experience, as well as an average of 19 years of tenure at Carlyle. In addition, turnover of senior professionals over the past 5 years has been limited. As Kevin mentioned during his introduction, the division previously invested in Fund 5 back in 2006. And when underwriting Fund 10, we've been heavily encouraged by the fact that many of the junior professionals who were present during Fund 5's investment period have since risen up the ranks to become managing directors themselves. To elaborate on the strategy, Carlyle employs a nimble thematic investment strategy that has historically enabled them to be ahead of the pack. Carlyle evaluates each investable sector based on 4 key factors: the average tenant's length of stay, operating margins, demographic tailwinds, and technology impacts. This framework has led Carlyle to identify the residential and industrial sectors broadly as the cornerstones of their portfolios. And to touch on alignment with the division, the Carlyle's thematic approach to real estate and their granular approach to portfolio construction aligns with our goal to position our real estate portfolio broadly to capitalize on post-correction market opportunities. And just to touch on the bottom line, Carlyle Realty Partners Fund Series has posted strong since inception performance. In aggregate, through Funds 1 through 9, they've invested $18 billion of capital into 1,164 total investments, with 781 of these investments being fully realized. In aggregate, these realized investments have generated returns of 18% net IRR. And in addition, Funds 3 through 8 are marked at first and second quartile returns compared to Cambridge Associates' non-core real estate benchmark. And that concludes my prepared remarks, and we're happy to take any questions.
Thank you very much. Any questions from the committee members? Good. Thank you very much. Again, I can report that the IPC reviewed staff's due diligence for this investment and recommended that it be presented to the council. So thank you, Kevin. Thank you, Adam.
Thank you.
Thank you, Adam. Thank you, Kevin.
So I think that's all the investment proposals for today.
That is correct. That is correct, Chair.
So we can now move for public comment opportunity. Ernestine, do you have any speakers?
So for this meeting, we don't have any registered speakers, which is the first in a long time. So what I can do is once we go into executive session, I'll send you guys an email with the link for that. You can click that and then you'll come back and rejoin using the link Gary sent to this meeting, and we can adjourn if that's okay with you, Chair.
I think that's terrific. So we are going to move into an executive session now. Thank you, Ernestine. And I would like to adopt a motion here to a resolution to go into closed session to discuss a matter where disclosure or discussion of this matter could adversely affect public interest. In accordance with the provisions of NJSA 10.4.12 B5 and NJSA 10.4.13 BEIT, resolved that the SIC go into closed executive session under the Open Public Meetings Act to discuss a matter involving investments of public funds where disclosure of the discussion could adversely affect public interest. The minutes of such meeting shall remain confidential until after such time as the council determines that the need for confidentiality no longer exists and the matters discussed can be disclosed. So can I have a proposal to go into a closed session, please?
Motion.
Can I have a
Michael
motion?
Cleary.
Second,
Thank
Aronson.
you. Thank you, Mr. Anderson. Ernestine, please take a vote by roll call on the motion to go into closed session.
Sure, Mr. Aronson.
Yes.
Mr. Bore, did you ever join? Mr. Bruno is gone. Mr. Carr,
Approve.
Mr. Cleary,
Yes.
Mr. Crow is off. Mr. Greeny,
Approved.
Mr. Hanson,
Yes.
Mr. Liebtag,
Yes.
Mr. McGuckin,
Yes.
Mr. Pandiri,
Yes.
Mr. Raj,
Yes.
Mr. Richard,
Yes.
Mr. St. John,
Yes.
and Mr. Yarensinski.
Yes.
You should have the email for the link. Please use it to join. Gary, if you can hold this meeting open until we reconvene.
So Ernestine, we are getting off this, going to the new link, and then come back to the previous link we had.
That's
Right.
correct.
Okay, okay, great. Okay, see everybody in a couple of minutes. Thank you.
Thank you.
Ah.